Let's bring in a frequent guest with us right here on The Close. We're talking about Lincoln Ellis. He's the Chief Investment Officer at Strategic Financial Group. That's an investment advisory firm and a managing director at the Lynn Group, which runs several commodities hedge funds. How are you?
I'm well. How are you?
I'm good. What do you make of the market? Or up here 3 months in a row?
Up 3 months. We continue to, with the exception of last week, be up, 6 of the last 8 weeks. And we're heading into this first day of March being up 11 of the last 13 first days of the month.
And that tells you what?
Well, it tells us that, we're watching money flows. Julie was talking about it earlier, very low volume. These money flows are driving asset prices. And Dominic's research on the bearish indicator, there are no sellers out there. And if you ask our friend Joe Saluzzi about market structure, that could spell a very interesting March for many investors.
I do want to head out to Chicago. Michael Palmer is a volatility trader with Group 1 Trading. He's at the Chicago Board Options Exchange. So, Michael, some gains today, very light volume. We continue to see this lack of volume here. No conviction. Does that mean to you that we are setting up for maybe a significant pullback at some point over the next couple of months here?
Well, it's certainly been a slow start to the month. We're seeing the sell-off last week, and we've seen the rally since. But the truth of the matter is the VIX is trading about 1850, which is $2 higher than the low we saw only weeks ago. So while there's still some complacency towards risk in the market, it certainly isn't low as it was, just a few weeks ago.
You're nodding away here, Lincoln.
Well, I think there are other spread indicators that show you that the risk is still out there. The large to small cap spreads that we watch came in 1%, and they actually were down today. The Russell 2000 was actually off probably 2 or 3 points. And then other pieces of risk that we look at in the FX market, the Swiss currency, particularly against the U.S. dollar, is trading within 50 ticks of its high, and that has really become the barometer, much more so than yen, much more so than the euro. U.S. dollar cross of a sort of risk aversion trade that is still very much in the market.
It's still in the market. You think so? You think so?
Oh, absolutely. I mean, we're coming up on these highs. You see all of the short sellers move to the sidelines. We understand exactly what the Federal Reserve is looking to do and trying to do in terms of jump-starting the employment. But when you go back and look at history and the numbers, there is no correlation between monetary policy and job creation.
Well, it's interesting. You talk about correlation. Hey, Dom, I want to bring you into this right now because you've been looking actually into the correlation between stocks and the economy. What are you finding here?
Well, the interesting part about this, we were having a discussion here in the assignments desk in our newsroom with Eric Chemi. We were taking a look at the weekly close of the S&P 500. Check out this chart here. This is going back about 30 years, okay? But if we go back 15 years, the average weekly close of the S&P 500 over the past 15 years since 96 is 1138, okay? If you look at where we are right now, it's 1325, or almost 200 points above where the average has been over the last 15 years. So it begs the question, do we deserve to be at 1325 right now? Is the economy that good? Are things that great out there? And Lincoln, and maybe I want to toss this out to you here, because seriously, 200 points above where the average is right now, is it justified, is the question.
Yeah, Dom, we think that it's probably not. I mean, we think that it's probably above that 1130 whatever number that is, but it is certainly not at the 1220s. It's much more in the 1150 range, and that would take into consideration extraordinary profit margins that were 8.8, almost 9%.
Well, that's what I was going to say to you. Why not? Because it seems like the corporate balance sheets are certainly very healthy. We constantly talk about how much cash they have on hand, revenue and earning numbers looking rather strong.
Right. So what our friend Dan Alpert would tell us about corporate cash balance sheets, and that's telling you that actually corporations are seeing what's happening in the economy
and holding on to cash.
And they're holding on to cash because they don't see anything worth going out and doing. Warren Buffett may be a different story, but most corporations are not out there aggressively hiring, looking for deals, or spending any of that cash.
Michael, are you as bearish as Lincoln is? Because we are starting to see some deal flow. We are starting to see corporations loosen up on dividends. We're starting to see them do more buybacks. I mean, where are you on this?
Well, it's sort of my job to watch the volatility in the marketplace. I don't really make too many judgments about which direction the market's going to go. But part of me thinks that, we see interest rates so low, there's really not that many places to put your cash right now. And I think the market is the beneficiary of that situation.
Someone who does like to make judgments on where the market is going to go is Jim Rogers. And we did catch up with him earlier. He talked to Bloomberg television out in Hong Kong on his investing attitude in a bull market. Here's what he had to say.
I don't want to be short or to avoid anything when the secular bull market is taking place. I will hedge myself by shorting something. I'm short emerging markets, for instance, right now. I'm short NASDAQ stocks, for instance, right now. So in the bull market, you don't want us to avoid, you want to own everything, even the ones you think are bad, because that's where the great gains are.
I mean, do you agree, Lincoln, at this point, you can't kind of fight the overall upward trend that we're seeing in many of the asset classes?
Yeah, that's certainly been the case. And all you've been able to do is sort of buy the things that you know have fundamental stories in them, buy things that are defensive in nature in terms of owning dividends, perhaps owning hard assets like Jim often does, and then hedge yourself up with places where you see cyclical weakness, either in Jim's case in the NASDAQ, and in our case, we think that small cap stocks is probably a good place to hedge yourself out for any kind of cyclical downturn.
We were talking a little bit about deals, and Julie, I want to bring you into this because we are seeing another deal here when it comes to healthcare REITs.
That's right, the second in one day, Carol. Who knows if it was a coincidence, if the one announced this morning nudged the second one to completion. But this morning, remember, Ventus acquired nationwide health properties, about $5.7 billion. That's going to create the largest healthcare real estate investment trust. And then just a few moments ago, saw the news flash across my screen that Healthcare REIT, that's what the name of the company is, sort of describes what it does. Healthcare REIT is going to be acquiring privately owned Genesis Healthcare for $2.4 billion. So two pretty sizable deals here, $5.7 billion, $2.4 billion. We've already seen some consolidation in the healthcare industry, but not so much on this sort of sub part of that industry. So obviously there's a lot of changes that are going to be happening in the industry as a result of healthcare reform.
Right.
And that's one of the factors that's pushing these guys towards some of these mergers. But, you know, despite what Lincoln said, these are companies that are definitely using their cash.
They definitely are. Hey, listen, so some news in the healthcare REITs, I should say. We also mentioned earlier some news in the energy sector. Dom, let's bring you back for this because we talked about the U.S. approving the first deep water drilling in the Gulf of Mexico since that BP oil spill.
Yeah, and maybe the BP oil spill being those memories kind of put on the back burner here. And maybe coincidentally or not coincidentally, this notion that with all of this Mideast turmoil right now, you're seeing oil prices hovering to highs and highs, the pinch being felt at the pump. Maybe now is a time to maybe start exploring more of those Gulf assets, oil assets, reduce that foreign dependence on oil, that kind of thing. All of those discussions coming back. You can see Transocean, Noble, Ensco, a lot of these guys starting to move up on this news here. So the question is whether or not we see this kind of a move play out more down the line as the Gulf of Mexico starts to open up for business once again. And that's the real issue here, is whether or not we can see these supply shocks from the Middle East, carry future into the future, rather.
Lincoln, how worried are you about the energy market potentially, providing another shock here to the economy when you would consider it's still somewhat fragile and delicate, maybe?
Yeah, absolutely. And I think that the real price of oil is actually the Brent price of oil, not the WTI. We have this, statistical problem with the WTI. So we think that the price of oil actually probably raises another $10 over the course of the next couple of weeks as the fragility of what's going on in North America begins to unpack itself. And the lack of clarity that we have both in terms of our own ability to respond to what's going on there, and then secondarily to help build out the aftermath of what's been going on will be put to the test.
All right. Certainly there's going to be a lot on tap this week to keep everybody busy. Lincoln, thank you so much. We appreciate it. Lincoln Ellis, Managing Director of the Lynn Group, and of course Michael Palmer out there in Chicago. Michael, thank you as well.